Hey, what is going on, guys? My name is Nick, and in today's video, I'll be sharing the 7 best stocks to buy before 2022. So far, 2021 has been an excellent year to be invested in the stock market, with the S&P 500 being up 24% year to date and over 40% over the past 365 days. We have yet to know what 2022 is going to bring us, but I've compiled my list of the top 7 stocks to invest in before the new year, as I feel these companies are very undervalued and still have tons of growth over the next 5 years. So if you do enjoy, make sure to smash the like button and don't forget to subscribe if you haven't already so you don't miss any future uploads. I also want to thank today's video sponsor, The Daily Upside, which is a free financial newsletter, but more on that later. So without further ado, let's jump right into these 7 stocks. Alright, now the first stock to buy before 2022 is Amazon with ticker symbol AMZN, but if you are Canadian, you can also purchase Amazon on the NEO exchange for just over $20 a share, which is certainly more affordable. Anyways, Amazon needs no introduction as the world's largest e-commerce and cloud computing business, giving itself an incredibly large moat to fend off its competitors. Amazon has done incredibly well over the past decade, with its share price up about 1,300% since 2001 and nearly 200,000% since their IPO back in 1997. Needless to say, Amazon is a freaking beast stock, but they haven't really done much over the past year, with the stock price being overall flat. So let's jump into the recent Q3 earnings report to figure out why Amazon stock is a buy before 2022. Amazon reported Q3 2021 earnings on October 28th, and surprisingly, they weren't very good. Unfortunately, Amazon reported EPS of $6.12 versus analyst estimates of $8.92, which missed by over 31%, and compared to Q3 2020 EPS of $12.37 per share, it dropped by over 50% year over year. Then they reported revenue of $110.81 billion versus analyst estimates of $111.6 billion, which was a slight miss, but luckily they did see annual revenue growth of 15% year over year. The CEO, Andy Jassy, said that the company expects to take on several $billion of extra costs in its retail business in the fourth quarter as a result of labor shortages primarily, the higher employee costs, global supply chain constraints, along with increased freight and shipping costs. He went on to say, "It'll be expensive for us in the short term, but it's the right prioritization for our customers and our partners." Overall, this definitely wasn't a good earnings report in terms of profitability, so why would I have Amazon on my list here today? Well, like I've said so many times before, Amazon is a very long-term investment in my own portfolio, and I really don't care what happens in the short term or on a quarterly basis, just like Warren Buffett would say. And instead of focusing on all of these scary headlines saying how bad Amazon performed in the quarter, it's important to listen to the company's conference call, hear what the management has to say, and focus on the company long-term. So here are a few key points that I gathered from the management team. First of all, Amazon is no longer capacity constrained like they were in the pandemic. And by the end of year, Amazon is on track to over double their fulfillment network ever since the pandemic began. Secondly, Amazon is seeing accelerating AWS growth to 39% year over year from 29% in the third quarter of 2020. And this is because they've become the preferred cloud provider for machine learning services, which have become better over time. Thirdly, the management team emphasized how customer focused the company really is. They said that right now, adding additional fees or having delayed shipping is not customer centric, and it really wouldn't bode well for Amazon in the long term. Now, they said that right now, Amazon is essentially the shock absorber for the retail business, so that the sellers and the buyers don't have to take the hit on any of these things. Amazon is just taking the huge hit up front, and I think this is a brilliant idea. And fourth and finally, Amazon is focused on building more Prime services to build up the value of Prime members. For example, they recently launched New World in Prime Gaming, which is a huge success according to Amazon, and they're also focused a lot on Prime Video and Prime Music, so that is great to hear. Overall, I think that Amazon is doing just fine in terms of building out their fulfillment network, increasing revenue, and increasing the value of AWS and Prime, but over the short term, they will continue seeing these increased costs. So it's important to keep a long-term mindset when investing in Amazon stock, and I'm sure they will benefit greatly from these investments right now at some point in the future. Now, before getting into our second stock to buy, I want to tell you about today's video sponsor, The Daily Upside. The Daily Upside is a free financial newsletter that shares some of the most important and engaging stories in business delivered to you before the market open every weekday. As an avid stock market investor, I like to make sure I'm caught up on the most important financial news relating to the markets and the companies that I follow, which which can be very time consuming. However, the Daily Upside is able to save me time and research by simply reading their 5-minute newsletter, which is actually quite entertaining to read, unlike other traditional financial news outlets. But it can also help me take advantage of opportunities in the market that I might otherwise be unaware of. For example, I recently read that one of my holdings, Apple, reported earnings that weren't as good as expected due to supply constraints that ended up costing the company $6 billion in the quarter. Normally I would listen to Apple's conference call to learn this, but the Daily Upside was able to summarize what I needed to know as an Apple investor. Sure enough, Apple stock was down 2% that day, which presented a good long-term buying opportunity. So make sure to click the link in the description of this video or in the pinned comment below to sign up for the Daily Upside newsletter completely for free. There's absolutely no downside to signing up. Anyways, thanks again to the Daily Upside for being today's sponsor, and let's get back to the video. Now, the second stock that I have for you today is Trulieve with ticker symbol TCNNF, or if you're in Canada, it's TRUL.CN. Trulieve is now the largest and most profitable US cannabis multi-state operator, or MSO, with a market cap of $4.7 billion after having recently acquired Harvest Health and Recreation. And if you aren't already aware, an MSO is just the term used to describe a large and vertically integrated cannabis company that operates in more than one state. Now, the majority of Trulieve's operations are still based out of Florida, but through the acquisition of Harvest, they now operate in 11 different states, having over 149 dispensaries nationwide. Since cannabis is still federally illegal in the US, these companies have to abide by state laws and can only operate where cannabis is legal for medical and/or recreational use. For example, Florida is now only legalized for medical use, but there is a chance they'll legalize for recreational/adult use at some point in the next few years. But despite these restrictions, the US cannabis industry is growing like crazy and is expected to over double by 2025 to $41.5 billion in total revenue, being a compounded annual growth rate of 21%. So being such a young industry in the US still, I think there's tons of opportunity for upside in Trulieve. Anyways, taking a look at Trulieve's Q2 2021 results back from August, we can see they've done incredibly well. Their revenues came in at $215.1 million compared to $120.8 million a year ago, representing 78% year-over-year growth, and from this they generated a gross profit margin of 67%, which is industry leading. Then Trulieve's net income came in at $40.9 million compared to $18.9 million a year ago, representing 116% year-over-year growth. But because they recently acquired Harvest, which is a smaller and still unprofitable MSO, Trulieve's profitability will be hit in the short term. But as they create synergies between the two companies and Trulieve's management increases the margins of Harvest, I think it's going to be a profit-making machine. And just so you're aware, Trulieve will be announcing their Q3 earnings sometime around November 15th, so definitely stay tuned for that because they will be seeing tons of revenue and EBITDA growth, I'm sure. Now, there are also some other upside catalysts to consider before buying Trulieve stock. The first major potential upside catalyst would be federal legalization. This would allow cannabis to be decriminalized and declassified as a Schedule I drug, meaning it could be used and sold anywhere in the country. Another major upside catalyst to consider is the elimination of the 280E tax code. Right now, cannabis companies are subject to the 280E tax code, which states businesses selling cannabis or any other federally illegal controlled substance cannot deduct any expenses incurred in the production, distribution, or sale of that product. As a result, Trulieve ends up paying a ton more in taxes, which ends up being about double, and this of course reduces their profitability. Now, the third catalyst would be the approval of the SAFE Banking Act, which stands for Secure and Fair Enforcement Banking, allowing cannabis companies to do business with major banking institutions. On September 21st, the SAFE Banking Act was actually added to a House bill, so this would allow companies to earn much lower interest rates on loans, as well as take credit cards as payment options. And finally, the fourth and last catalyst is the uplisting of these cannabis stocks from the OTC exchanges to the major exchanges. As of now, Trulieve is stuck on the OTC exchange, which is known as the over-the-counter in the US because the drug is still federally illegal. However, once federal decriminalization comes around, Trulieve and other stocks could uplist to the NASDAQ or the New York Stock Exchange, which would massively increase the investor base. Furthermore, hedge funds and mutual funds are not allowed to invest in these cannabis companies for the same reasons stated before, so this would definitely increase the amount of investors in these companies. Overall, there are countless upside catalysts for Trulieve over the short term and the long term, so I'm very excited to see where this stock ends up going. Alright, now the third stock to buy before 2022 is a company known as Meta with ticker symbol MVRS, which is actually Facebook's new name and ticker symbol that will take effect on December 1st. Until then, you can still buy Facebook stock under the ticker symbol FB. Now, Meta is of course the company that owns Facebook, Instagram, WhatsApp, and Messenger, and across this entire suite, they have daily active users of 2.8 billion and monthly active users of 3.6 billion. So based on the total world population of 7.9 billion, over 45% of the world uses one of Meta's products on a monthly basis, which is insane scale. Now, the company did just report their Q3 earnings, which were a little bit underwhelming. So Meta managed to grow its revenue by 35% and its EPS by 19% year over year, despite the challenges faced by the Apple iOS 14 changes greatly affecting the company. But unfortunately, they did miss most analyst estimates and didn't see quarter-over-quarter revenue growth. However, they did announce a huge increase of $50 billion to their share repurchase program, which is great news for investors because the stock is so cheap right now, and obviously management thinks so too, and they plan on scooping up these shares at the discounted price. Meta also announced they will be implementing a new financial reporting structure for the future where they will break down the family of apps and the Facebook Reality Labs results separately. This all stems from their recent name change to Meta and Mark Zuckerberg's overall focus on creating the metaverse. So what even is the metaverse? Well, here's a clip from Meta's recent keynote presentation to give you an idea.
Imagine you put on your glasses or headset and you're instantly in your home space. It has parts of your physical home recreated virtually, it has things that are only possible virtually, and it has an incredibly inspiring view of whatever you find most beautiful.
Hey, are you coming?
Yeah, just gotta find something to wear. Alright, perfect.
Oh, hey, Mark.
Hey, what's going on?
Hi, Mark. What's up, Mark?
Whoa, we're floating in space? Who made this place? It's awesome.
Right? It's from a crater I met in LA.
This place is amazing.
Boz, is that you?
Of course it's me. You know I had to be the robot, man.
I thought I was supposed to be the robot.
Whoa.
I knew you were bluffing.
Hey, wait. Where is Naomi?
Let's call her.
Naomi.
Hey, should we deal you in?
Sorry, I'm running late, but you gotta see what we're checking out. There's an artist going around Soho hiding AR pieces for people to find.
3D street art? That's cool.
Send that link over so we can all look at it. This is stunning.
Okay, that is something.
That's awesome.
Wow. I love the movement.
Wait, it's disappearing.
This is amazing.
Hold on, I'll tip the artist and they'll extend it.
Wow. Brilliant. If you guys like it here, I have another room that you're gonna love. Check out this forest room.
Huh, let's see it.
Koi fish that fly? That's new.
This is wild. Hey, one sec, Boz. It's Priscilla.
Hey, you have to see this. Beast is going crazy.
Oh, I love that guy. We've got to show that to the kids. Can you also send that to my dad?
I'll message him.
All right, see you at home. This place is great, Boz, but there's something I gotta get back to.
So the metaverse is going to be about social interaction in a whole new way, but it's also going to be pretty useful in areas such as work, business, and school. So check this out.
Now, what about unlocking more mixed reality experiences? I mean, imagine working at your virtual desk with multiple screens while seeing your real desk so clearly that you can pick up a pen and write notes without taking your headset off. Or, you're doing a workout with a virtual instructor in your living room.
It's gonna be so cool.
Anyways, the metaverse is going to be the primary focus of Meta over the next decade, and as such, they plan on hiring 10,000 employees to be able to build out the metaverse. But Mark Zuckerberg said it's not going to be a profitable investment for several years, and it's going to take a ton of investment capital over the next decade, so we'll just have to see how this plays out. Overall, I'm a big believer in the company, and I love what they're trying to do with the metaverse, but if you are investing in Meta, you do have to have that long-term focus because it's not going to be a profitable investment anytime soon. All right, guys, now the fourth stock on the list here today is Suncor Energy with ticker symbol SU.TO here in Canada, or SU if you're in the US. Suncor is Canada's largest integrated oil and gas company, meaning they have operations spanning from the upstream mining of oil sands all the way down to the downstream refineries and Petro-Canada pump stations. Now, Suncor was hit incredibly hard during the global pandemic, where it dropped well over 50% from the 2019 highs, and it still hasn't even recovered covered, which I believe presents a good buying opportunity for a few reasons. Firstly, we can see that oil prices have been trading higher and higher over the past several months, recently surpassing $80 a barrel, and some say the momentum could continue past $100 per barrel. And the last time oil surpassed $70 per barrel back in 2018, guess where Suncor stock was trading? $55 per share, so this makes today's valuation look incredibly cheap. Secondly, Suncor just released their Q3 earnings report and the results were quite incredible. Suncor generated net income of $877 million compared to a loss of $12 million in the third quarter of 2020, and they produced funds from operations of $2.6 billion compared to $1.2 billion in Q3 last year, which were basically in line with what analysts expected. And despite having the highest maintenance activity over the company's history this year, Suncor managed to have great production and they also completed all of these turnarounds on budget. In fact, Suncor had a 99% utilization of their refinery in Q3 2021, which is great to see. And moving forward, management says they've completed all the turnaround activities for 2021 and moving forward, so they can take full advantage of Q4 high oil prices. Thirdly, Suncor has been strengthening their balance sheet and increasing shareholder returns massively. So far in 2021, Suncor reduced their net debt by more than $3 billion and produced shareholder returns of $2.6 billion in the form of dividends and share repurchases. In fact, the biggest news of all from their last earnings report that just came out, Suncor is increasing their dividend by 100% back to the 2019 levels, so that is great news for dividend investors. As a result of the news, the stock was up over 13% on Thursday to $32 per share, which at that price gives Suncor a forward dividend yield of 5.25%. In addition, Suncor increased their share repurchasing program from the remaining 2% of outstanding shares to 7%, and in 2021, the company will have bought back the highest annual percentage of shares in the company's history. As for next year in 2022, the company is expecting an increase in $400 million in free funds flow, and this would be a result of increased cost savings, synergies, and margin enhancements, which should continue to give shareholders better returns over the near term. Needless to say, Suncor's management is very focused on reducing debt and giving back everything they can to the shareholders, so this is great news for investors. Alright, now the fifth stock to buy before 2022 is a company that you've probably never heard of, and that would be known as Google, with ticker symbol GOOG. But again, if you're a Canadian, you can also purchase Google on the NEO exchange for just over $25 a share. Google is the primary search advertising behemoth, which also owns YouTube and is responsible for 92% of the world's search engine traffic. As I spoke about in an earlier video, Google is one of the very few companies that essentially operates as a monopoly because of its incredibly high market share, thus giving itself an incredibly strong moat. Just take a look at this chart. Ever since 2010, Google's market share of above 90% has been unwavering, proving that people just continue to use Google without even thinking about it. Now, Google also just reported their Q3 2021 earnings, and despite many of the other tech companies not doing so well, Google actually blew their numbers out of the water. In Q3, Google saw revenues of $65.1 billion, up 41% year over year, compared to analyst expectations of $63.3 billion. Then for EPS, Google earned $27.99 per share, representing growth of 71% year over year versus $23.48 per share expected by analysts. YouTube ad revenue did come in slightly below analyst estimates at $7.2 billion versus $7.4 billion expected, but still represents year-over-year growth of 43%, which is incredible to say the least. Looking at their valuation after the stock jumped over 6% on the earnings results, it's still pretty reasonable in my opinion. With their market cap at $2 trillion, Google is trading at a trailing PE of 28, while analysts only think the company is going to grow 4% next year. So I think this is grossly underestimated, and Google should continue to outperform the market in 2022 if I had to take a guess. Forgetting all other avenues that Google is investing in, I think that ad revenue growth is still going to continue well into the future for YouTube and Google search. Overall, with the e-commerce market expected to expand by another $1 trillion by 2025, you can bet your bottom dollar that Google will benefit from this in terms of ad revenue. Now, coming in with the second last stock to buy before 2022, that would be a company known as Peloton with ticker symbol PTON. Peloton is the largest interactive fitness equipment company in the world, which has completely disrupted the exercise industry to say the least. According to their mission statement, Peloton uses technology and design to connect the world through fitness, empowering people to be the best versions of themselves anywhere, anytime. Peloton uses technology to essentially gamify the exercise industry, and needless to say, it's done very well for them so far. This company has seen 100% compounded annual revenue growth over the past 6 years years and has been able to create a community of over 5.9 million members. However, throughout 2021, not everything has been sunshine and rainbows for Peloton. The company ran into safety issues with its Tread Plus product where they had to halt sales and issue a recall, costing them hundreds of millions of dollars in lost revenue. Furthermore, coming out of the pandemic, demand for Peloton products began to drop off as more people became outdoorsy. On top of all this, new competition has emerged in the virtual and gamified fitness industry, such as Lululemon's acquisition of Mirror, as well as other competitors. However, despite all of these challenges faced in 2021, I am still very bullish on Peloton for 2022 and beyond, and here's why. Firstly, Peloton has been expanding their supply network, the future product categories, as well as the locations they operate. On April 1st, Peloton completed its acquisition of Precor, which is one of the largest global commercial fitness equipment providers, with a significant manufacturing presence in the US. Now, Peloton will not only be able to build its bike and its tread products within these Precor factories in the US, but they'll also be able to take advantage of the expertise Precor has in other areas such as rowing and strength training equipment, and this would allow Peloton to expand its product categories in the near future. Additionally, Peloton recently announced its move to Australia, which shows that the company is dedicated to serving many more markets than North America and should continue doing so. Secondly, Peloton recently announced their own private label apparel brand known as Peloton Apparel. This reminds me a lot of Lululemon's apparel with a very comfortable, stretchy, and athletic material. And the best part about this is that their online instructors are always wearing the apparel, which gives Peloton essentially free advertising to its over 5.9 million members who are now subscribed to the Peloton services. Lululemon doesn't even have this huge of an advantage, yet they've been able to build a $60 billion business based on apparel, so I think there's huge growth for Peloton in the future. And thirdly, Peloton's valuation is getting much more attractive after the recent 50% drop from earlier highs this year. Right now, Peloton is trading at a price to sales ratio of 6.7, which in my opinion is quite cheap for a company continuing to grow revenues over 50% per year. For comparison, Apple, which is also a hardware and software company like Peloton, is trading at a price to sales ratio of 7.3 and is growing much slower, albeit extremely profitable. So I think Peloton has some massive growth drivers that will allow them to continue propelling growth in 2022 and beyond, but it's definitely not a profitability story right now as they still are unprofitable, so I'm definitely in it for the revenue growth. All right, and now for the final stock to buy before 2022, that would be Apple with ticker symbol AAPL. Apple needs no introduction as the company that creates the iPhone and has recently transformed into more of a service-focused company, sort of like Microsoft, through providing their Apple Music and Apple TV Plus streaming services, among others. Now, Apple recently announced their Q3 earnings on October 28th, so let's get into those results right now. The company reported revenues of $83.4 billion versus $84.85 billion expected by analysts, which grew 29% year over year, but did miss analyst expectations, mainly because of those supply constraints. And they reported EPS of $1.24 being in line with analyst expectations, which grew 70% year over year, and this is just incredible. But they are seeing slower revenue growth than right after COVID, just like Amazon, because of the supply constraints, the high labor shortages, and the ongoing chip shortage, so these are all challenges both Amazon and Apple have to face. Apple also recently just had an event on October 18th where they announced the new M1 Pro and M1 Max MacBook Pro laptops, and this was absolutely incredible, guys. Without getting into too many of the details, Apple once again just proved its dominance over Intel, being the superior chip maker with its M1 Pro chip and its M1 Max chip. As a YouTube video creator, I was incredibly impressed with all of the specs that the 14-inch had, and I ordered that MacBook Pro right away. My current Microsoft Surface laptop just really is not powerful enough to be able to do the types of things that I need to do, and I can see that the Apple product is going to be amazing for years to come. Don't just listen to me though, all of the reviews online have been outstanding. And even though the MacBooks only represent a small portion of Apple's total revenue, this just goes to show that Apple continues innovating at record-breaking speeds, and that they're able to maintain their competitive moat in the smartphone and technology industries that they operate. And based on the usefulness and necessity of Apple's products within our daily lives, I'm surprised that Apple isn't trading at a higher multiple than they are today. Right now, Apple's trailing PE ratio is 29, while their forward PE is 26.7, which are quite reasonable in my opinion. Overall, Apple's one of those companies that you could probably just buy into and not even look at for the next decade and still make money and do very well for yourself, so So that is why they are on the list today. And that is all I have for you today. Wow, I am exhausted from saying all that information, so give me a like on the video and let me know what you thought. And are there any other stocks that you would add to this list to buy before 2022? Are there any really good opportunities that you see in the market? Let me know down below in the comments. I would really love to read it. So anyways, if you haven't already, make sure to subscribe for more content coming in the near future. And with that said, I will see you guys in the next one.